Hi there, this is Alvin from Dr. Wealth. We know that in the news now there is this serious US bank failure that's going on, and it's definitely has spooked the market. So the bank that went into this failure mode is Silicon Valley Bank. It has now halted for trading, and the FDIC has taken over the control of the bank and trying to find another buyer and any bank that's willing to merge with this SVB to help salvage the situation. So this is not the first bank that ran into issues, and previously we heard about this Silvergate, which has been known as the biggest crypto lender, and it decided to liquidate itself and return money to the depositors, and that's it. Okay, so now the question is there a bigger bank failure that is affecting the US stock market? And would it be a repeat of the 2008 financial crisis? So I hope to give you a situation update about this, and of course share with you my views, what I think about this issue. So we all know that with that crisis unfolding, a lot of the US banks were in the red in terms of their stock performances, especially the regional banks, the smaller ones. But one particular surprising one was Charles Schwab, which is one of the largest bank in US and is also in a very negative situation. Not just that it tanked the first day, the second day it also tanked another double digit. And so something is fishy going on, right? So we don't know how many more banks are having this issue. And luckily, there are bigger banks like JP Morgan managed to recover some gains on the second day. After it fell 5% on the first day, it recovered about 3% on the second day. So still not that bad. It seems like the stronger banks, the banks that have more diversified in terms of their sources of liquidity, they are still likely to survive. But the same cannot be said for the smaller banks, especially regional banks. Okay, so basically what is the issue that's affecting these banks? So let me break it down for you, right? So the issue was that the deposits have rose because of the liquidity that the Federal Reserve have been pumping into the economy. And the banks with all this deposit, of course, they could not just take on the risky bets, and they need to find enough borrowers to take the funds. So what happened was that many of these banks started to buy US treasuries, right? Because they are safe assets. So we all know the Federal Reserve have been raising the rates, and the issue is that treasuries or bonds, they move opposite to the interest rate direction. So if interest rates are going up, that means the bond prices or the treasury prices are falling. So the banks that have bought a lot of these treasuries now faced with negative bond values, negative treasury values. We are talking about in the billions. And usually there's no issue with this, because if they hold these treasuries to maturity 6 months down the road, 1 year down the road, they will be able to recover 100% of the funds. So there's no issue. But the issue comes when there is a bank run, when there is more than normal depositors withdrawing their money. That is where the banks start to suffer this liquidity crunch. They need to sell the treasuries at very deep losses in order to raise the cash to return the money to the depositors. So that is the crux of the issue. So for Silvergate, because the crypto market has collapsed and investors started to pull out, start to liquidate their position and demand their cash back. And that's where Silvergate realized that, oh, we need to sell the treasuries as a loss. So the funny thing is that it's not the crypto that killed Silvergate. It is something that's more secure, which is the US Treasury. And the same thing happened to this Silicon Valley Bank, right? There is a rumor spreading around, and Peter Thiel, one of the venture capitalists, has also advised its portfolio companies to withdraw money from the Silicon Valley Bank. And for SVB, with this sudden surge of withdrawals, they need to sell the treasuries at a big loss, and the story repeats itself. And that has caused the US stock market to crash. Okay, I would say that it is in a bad situation because now S&P 500 is trading below its 200-day moving average. To me, that is a bearish indicator. And that means that there are more downside for S&P 500 to go, unless it can really recover way above the 200-day moving average and really clear of it and just take off from there. Otherwise, I think the bear is back in control right now. We should see more downside going forward. Okay, so that is the bad news I want to break to you. And some may argue that the bearishness is not caused by the banks, it's caused by the interest rate hike expectation that has changed. Okay, because the Federal Reserve seems to be more hawkish now, and the peak interest rate is going to raise. Okay, initially, yes, I would say that the interest rate was the cause of the S&P 500 index for coming down, right? General US stock market is weakening because of the increase in the interest rate expectation. But recently, it is not due to interest rate. Okay, in fact, it is likely due to the banks collapse. the SVB issue, because investors, some of them are thinking that domino effect might happen to other banks, and if there's really a bank crisis, the whole stock market in the US is going to be very, very bad, right? It's really a repeat of the 2008 financial crisis. And I want to explain to you why, right? Why I think so. Okay, so for example, you look at the bond ETF, the 7 to 10 year bond ETF, the price actually spiked. Okay, in fact, the yield actually collapsed after this bank issue has been surfaced. By right, if the interest rate is expected to hike even more, bond prices should fall. Remember the inverse relationship. But in this case, the bond prices actually went up by 2% over the last 5 days, and the spike happened to coincide with the bank failure period. So I would say that now it is a flight to safety, right? Because investors now are dumping shares and buying bonds, and that causes the bond prices to go up and yield to go down. So it is not really caused by the interest rate hike changes. So now the narrative for the stock market has changed. It is really driven by this bank failure that's going on right now. And lastly, now FDIC has taken control over the SVB, and hopefully they are able to find another bank who is willing to merge with SVB and stop this cascading effect, because they need to restore depositors' confidence. If all the other depositors in other banks start to worry about this and withdraw their money at big amount, then that's where more bank runs will happen, and that's where more bank failures will happen, and that's when the whole stock market will collapse, because the risk-off mode, the degree of fear is going to be so tremendous that the sell down is going to decimate the stock market. Okay, so I really hope that this issue will be resolved as soon as possible, because if it doesn't, this might be even worse than the interest rate hike that we've been experiencing in the past 1 year. So sorry, I don't have good news to share in this video, and now it's really dependent on how the US side can really resolve this issue. So hopefully this information can help you make a more informed decision of what to do with your investment. Hope you like this video. Give me a thumbs up if you find it useful, and remember to subscribe so that I can give you more timely analysis of important events in the future. Thank you for watching, and goodbye.